Hi, welcome to the mid-year Evergreen Outlook and Positioning webinar. My name is Andy Harris. I've had the opportunity to meet many of you. I'm CEO and co-founder of Evergreen Wealth Solutions, and today I will be meeting with you and Derek Varner, who's a member of our investment committee. And Derek will be presenting the Outlook and positioning section, and I wanted to go over a few firm updates before we turn the reins over. First and foremost, we're very excited to announce that Todd Rischel, CFP, has joined the firm. Todd, who we've known for quite some time, has been working in the industry since 1992 when he started with Prudential Securities. He then joined M&T in 1997, and during his tenure there, he obtained his certified financial planning designation. He was there for over 25 years and just recently joined us here in July of 2023. On the personal level, Todd and his wife Jen reside in Nipkonos Valley. They've got 3 adult children and 5 grandchildren. Coincidentally, Todd happened to work with Ed Barone, Georgia Potts, and Deneen Grimes for quite some time. So he's a very known quantity, and we're very excited that he's joined the firm. In other updates, last quarter, I introduced Justin Warfel as a new associate advisor who will be specifically helping me with the clients that I directly serve. He recently passed his Series 65 and is now starting his course of study on the CFP designation track. So he will be more of a presence in ongoing meetings. This video is going to focus on Outlook and positioning, but one of the things that I do want to mention is that we will be talking about Roth conversions for many of our clients that are in the retirement phase or for whom that is appropriate. The Tax Cut and Jobs Act has shifted tax brackets up until the end of 2025. So during a review, that may be something that we're talking with you about, and that's one of our initiatives for 2023 to make sure that we have those conversations. And if it's been a while since you've connected with your advisor, that is a topic that we think is worth discussing. But without further ado, I'd like to turn the reins over to Derek, and I'll be back on the end.
Okay, great. Thanks, Andy. It's always great to hear about growth initiatives at the firm. That's tremendous, and also great to hear about ways to avoid paying taxes. So two subjects that are near and dear to me. So I'm going to share my screen, and we're going to walk through what we're witnessing in markets and economies this year. So on screen, you should have the Evergreen Outlook and Positioning for July 2023. It's been a busy first half of the year. We've had, after a very rough 2022, we've had a decent rally so far in 2023, driven primarily by large cap U.S. technology companies. They've driven the S&P 500 higher by about 17%, but we've started to see other parts of the market begin to participate in the what seems to be a new bull market forming as well. So whether it be small cap stocks, which are up about 8% this year, foreign equities up about 12% this year, even emerging markets up 5%, and bonds, after one of their worst years on record in 2022, have begun to show signs of life again in 2023. So in this webcast, we'll talk about where we see opportunities that could still participate in future gains for the rest of 2023 and beyond. We'll also touch on what we're seeing in the economy in terms of, will we go through a recession? What are the key drivers of economic stability? What are areas of concern? And then again, we'll talk about key portfolio themes that we have exposure to on behalf of clients today. As I mentioned, much of the market has been driven so far this year higher by a handful of large technology companies, whether they be companies like NVIDIA, which makes computer chips that support the artificial intelligence computing that's become so popular in financial media and just mainstream media so far this year. NVIDIA has done exceedingly well, up almost 200%. Other large companies like Apple, Microsoft, and Amazon up 40 to 50%. But we were seeing a decent amount of dispersion in the market this year, where even household names like Walt Disney, Verizon, Nike, Bank of America really haven't participated in the rally, all kind of flat or down. So we'll talk about where we may see opportunity in other parts of the market beyond large cap technology stocks, which our clients do have exposure to. Now we're looking for areas beyond that to continue to add value. We like to remind folks that the stock market and the economy are not the same thing. The stock market is made up of expectations about the future. So, how many Americans will be employed next year, how many iPhones Apple will sell. The stock market, again, is made up of expectations about the future. So what we often see is, particularly during periods like this one, we often see the stock market begin to bottom and recover as expectations about the future getting better than today. We often see that occur and transpire before the economic cycle begins to bottom and move higher. So we were trying to get the message out as much as we could last year in videos like this and our written communications. When things felt pretty rough in the summer, inflation was very high, and we'll touch on that in a minute. We were encouraging clients to stick with their long-term financial plan, remain invested, because we saw value in the market. It's a great quote from economist Paul Samuelson. He said, "The stock market has predicted 9 out of the last 5 recessions." So it's a great quote. It's a quip basically to say that markets tend to sell off at the sign of bad news, but oftentimes that bad news doesn't play out, or it's not as bad as expected. And we think 2022 we saw lots of areas where expectations were much worse than reality, and that may have presented opportunities for us and our clients. As I mentioned last year, inflation was very, very high. We saw the highest year-over-year consumer price readings around mid-last summer. And then we started to see that trend inflect lower. And in fact, today, this morning, we actually got the lowest year-over-year consumer price index print since March of 2021. So we are starting to, this trend has continued, and inflation has continued to move in the right direction. But if you think back to last summer, household sentiment was very low. It was actually one of the lowest readings we've seen in many decades. Folks felt as bad as they had in a long, long time when asked about their own economic situation and their future economic prosperity. Investors felt very bad as well. Investor sentiment was near a record low. So we like to go back to this great Warren Buffett quote: "Be greedy when others are fearful, and fearful when others are greedy." We saw a really decent amount of fear in the market mid last year. And if we look from that point forward, this is a 1-year return on the S&P 500. The 1-year return from mid last year, from last summer, is about 18% higher. So sometimes these things aren't always intuitive, that the market and the economy aren't the same thing, but we like to try to encourage clients as much as we can to stay the course and stick with their long-term financial plan. The economy has continued to move forward at an okay pace, not gangbusters, nothing to write home about, but we don't anticipate a significant recession this year. And that's been, I would say that's been largely the market narrative for much of the second half of 2022 and even early 2023, particularly around the stress related to the banking crisis that transpired in March. We don't see it primarily because the U.S. jobs market has been just so strong. We have a record number of employed Americans in this country, and we've had a record number every month since last summer. The previous record was right before COVID in February of 2020, and we crested over that record of employed Americans last July, and we've been producing a new record every month since then. What's also encouraging is that despite concerns about the economy, we have not seen employers pull back on job openings. So in other words, the number of employers seeking to find employees is near a record high. There are 10 million job openings in the United States, which is almost 2 job openings for every person seeking a job. So that shows a lot of confidence in the economy from business leaders in this country. And so that's one reason why we're optimistic about the future economic growth. Households are in good financial shape on average. Everyone's personal situation is different, but when we look just at the average macro level, and we're trying to get our finger on the pulse of what's happening in the U.S. economy, we see, because of increases in 401k balances, increases in home value, home equity, we see household net worth near an all-time high. We see household debt service near an all-time low. So the average amount that someone spends servicing debt, so paying their mortgage, paying their auto loan, paying their student loan, is about 10% of their income, which is lower than it's been in quite some time. Mortgage delinquencies are very, very low. Everyone's paying their mortgage, which is a good thing. The one area of caution is we have started to see credit card debt pick up again. We're seeing a record amount of credit card debt in this country. So a portion of that economic growth may have been pulled forward from the future in the form of borrowing. We're taking that trip to Disney World on our credit card instead of paying for it out of pocket. So eventually that has to be repaid later, and that could pull forward some economic growth to today. Another area of caution, as we mentioned, this great Warren Buffett quote again: be greedy when others are fearful, fearful when others are greedy. If you remember last year, there was a lot of fear in the market. This year, with all the gains and the enthusiasm around artificial intelligence and how that can enhance productivity and drive, increase lifestyles and do a whole host of good things, we are starting to see investor sentiment creep up again. So investors are now above average bullish on the market, and that is a point of caution for us. Again, when folks are optimistic, we tend to get a little bit nervous. In terms of U.S. manufacturing, we highlighted in previous communications to you in videos and in written form, we were tracking the U.S. manufacturing sector, because this often is a very close coincident indicator with the stock market. When manufacturing moves up and down, that tends to very closely correlate with stock market bottoms, particularly when manufacturing bottoms and begins to recover. We've seen an attempt at bottoming in the U.S. manufacturing sector, so we're watching that very closely. But what's very, very encouraging is we've seen just an enormous amount of spending on U.S. manufacturing construction in this country. So you think about all the lessons we went through over the last few years around how fragile our supply chain was during the pandemic. Their companies and governments have been it's been very front of mind to move manufacturing closer to the United States, whether that be doing it here in the U.S. through reshoring of manufacturing activities, or doing it through quote unquote nearshoring in places like Mexico, as opposed to Asia or other parts of the world. In addition to those supply chain challenges, you've also seen direct government incentives to produce renewable energy related activities here and electric vehicles in the United States, as well as computer chips. We saw the large semiconductor bills to produce semiconductors, and that's now happening in Arizona, Ohio, and New York, as well as I said, through the Inflation Reduction Act, significant spending on renewable energy and electric vehicles. So encouraging sign for the future of manufacturing state in the U.S. One of the nice things about we went through a decent amount of stress moving from very low interest rate environment to actually a pretty high interest rate environment over the last 18 months. So we went through the fastest and steepest interest rate hiking cycle in the last 40 years, which had very significant effects on lots of different parts of the market and the economy, which we've talked about in past presentations, so we won't go into that here. We're going to focus on the future. And now what we're seeing is very good news for savers who can now earn 5% on their money markets, their fixed income securities, very low risk, their CDs again. So that's encouraging. And we've had a lot of clients come to us for assistance with managing cash allocation, short-term portfolios that had been earning next to near zero. Now we can earn 5% again. So that's encouraging. And we've been shifting portfolios away from alternative investments toward traditional bonds again that can add value. On the fixed income side, as I mentioned, higher yields on money markets, higher yields on other types of fixed income as well. In terms of the S&P 500 and where our markets today after the rally, when you look at the surface, the S&P 500 based on price to forward earnings. So what is the index and the companies that comprise it? What are they expected to earn over the next year? And how is the index priced? It's a little bit north of fair value today at about 20 times expected future earnings. But when we strip out those large technology companies, remember the Apples, the Amazons, the Microsofts of the world, and we just normalize the index for size, it's trading at a much more average price. So we would say the market is, more averagely priced today. Our clients don't own the S&P 500 index. We take an actively managed approach, and we try to pick the best stocks as opposed to just owning the market. So we think there's lots of value out there, not just in the S&P 500, but in other parts of the market. One of those areas is small cap stocks. The small cap stocks, so those are often defined as companies with market caps of $10 billion or greater. These are still large household names. For example, some of the biggest companies in the small cap universe still are large brands like Planet Fitness and the Cheesecake Factory and places like that are front of mind for consumers. But because they tend to be more economically sensitive, this part of the market, as I mentioned in the beginning, more economically sensitive, has really been unloved as folks have been concerned about a recession. We see potential value here, and this small cap stocks are now trading at a 50% discount to their large cap counterparts, and one of the biggest discounts on record. So we think that's an area of value. Another area of potential value is foreign stocks. So similar theme here, that these tend to be a little bit more economically sensitive, concerns about a recession. Our base case is that we're not going to go through a significant recession. So we see value in foreign stocks as well, which are trading near an all-time low discount to US large caps as well. We often get asked in a year like this one where the S&P 500, large U.S. companies have continued to kind of lead the way. Why own a diversified portfolio? Why should I diversify? I think that's a fair criticism. We would point to what you draw your attention to kind of these yellow lines here. This is different asset classes through time, through calendar years, and then through quarters of 2022 and 2023. And what you see is this tends to be a very random pattern. What outperforms in any one year tends to, underperform in the next year, and it tends to be very random through time. But what we find is that when we hold a diversified portfolio, that tends to smooth the ride. It's probably never going to be the best, but it's never going to be the worst. And we think that leads to good long-term outcomes for clients that are following a financial plan. Now, you'll notice, we had exposure to things like commodities, which were doing very, very poorly for much of the last decade. And we added that exposure in the last few years because we were concerned about an inflationary environment. The inflationary environment occurred, and commodities did exceedingly well over the last few years. And we think so. That's an area where being opportunistic and being diversified can add value. In terms of themes we're excited about, you probably heard us talk about biotechnology and innovative healthcare. That's one we've had exposure to for a while. This is an area where we're just seeing an enormous amount of cost reduction and speed in terms of the research that can be performed. So these companies are doing research to cure diseases and innovate new healthcare initiatives at a record pace. And they had done very, very well. So you see on this green line represents the biotechnology index, had done very, very well leading out of COVID. That was a point of caution for us when anytime we see these kind of parabolic moves, that's an area of caution for us. And then over the last few years have become very, very unloved by investors. This is an area where we still see a lot of long-term growth potential, and they're much more attractively priced today. So that's an area where we have significant exposure in many client portfolios. Another area is disruptive technology. We did not have a lot of exposure to this part of the market. Again, when it was rallying very heavily in 2020 and into 2021. This was the famous ARC Innovation Fund, which was famous in our industry. You may have heard it too, just in the general news. But what we like to show here for investors as a lesson is Morningstar does a great job at tracking investor flows into and out of the fund. So when you and I buy and sell an investment fund like ARC Innovation, and what we found was investors really did the majority of their flows, their investing into these speculative growth funds at the peak. So again, remember back to the quote, be greedy when others are fearful, fearful when others are greedy. There was a lot of optimism and enthusiasm and exuberance at this point, as denoted by the flows into the fund. Now take a look as you step forward, the fund starts to crash and we get to where we are today. Now notice there's not flows, it's the same companies, it's the same themes, it's innovation, it's artificial intelligence, it's renewable energy, it's autonomous vehicles, lots of things that could have the potential to really change the world. But if you notice, they're a lot cheaper today and investors aren't paying attention. So that's an area that we're excited about as well. Lastly, infrastructure is another key portfolio theme. The American Society of Civil Engineers rates U.S. infrastructure as a C-. If you remember school, that was not a good grade. We saw in Philadelphia, part of I-95 collapsed recently and shut down the highway. So that's just, one near-term example of just the challenges we face with aging infrastructure in the United States. And that same group, the American Society of Civil Engineers, estimates that it'll take about $2.6 trillion over the next 10 years just to get up to a B grade. So we think that there'll be a decent amount of investing in infrastructure in the United States. We want to be part of that, and globally. But we also believe that infrastructure not only includes traditional things like energy pipelines and roads and bridges and railways and airports, but also things like communication infrastructure, cell phone towers, data centers, even satellite internet, as well as water resources and renewable energy. So those are all areas that we have exposure to or actively seeking opportunities to gain exposure to. So when we think about the environment for investing today, we think the economy is not in bad shape, not in gangbusters shape, but okay. We don't expect a significant recession, primarily helped by the U.S. Labor market is in very, very good shape. Household sentiment is low, but moving in the right direction. Inflation is high, but moving in the right direction. Valuations on the surface look about fair. We think there are pockets of opportunity underneath the surface, which we're trying to gain exposure to and have exposure to. On the technical side, we're potentially seeing a new bull market form as we record this. I think we're still kind of on the cusp of that. So maybe more to report in a future video or a future communication, but we're on the cusp of a new bull market potentially happening. One area of caution for us, though, is investors have gotten very bullish very quickly. So that gives us pause. On the portfolio positioning side, we are overweight active management. We want good stock pickers. We want to be selective in the securities we own. As I said, we're overweight small caps and foreign stocks. We think those are areas that are unloved by the market and present a very good relative value opportunity. We did recently add back to interest rate sensitivity, and that just means we added back to bonds. Bonds for many years were paying almost nothing, and now we can get 5-6% yields again on very, seemingly safe, low volatility instruments, which is attractive. And then key themes like healthcare, infrastructure, and disruptive technology, as I mentioned. So to summarize, before I turn it back over to my friend Andy, we think the economy is in better shape than many believe, and that is presenting pockets of opportunity. We're not expecting a significant recession. Investors have turned bullish pretty quickly around things like artificial intelligence. That's just one reason to be cautious and sort of pump the brakes, at least in the near term. And then, while we pump those brakes, while we wait, we're getting paid to wait in the form of higher dividends on our equities, higher interest on our fixed income securities. So thank you for listening. And as Andy will say, we're at your service to follow up and talk about any of these subjects in greater detail at your convenience.
Well, Derek, thank you so much. Before you go, I just had two questions that I wanted to ask you. I think you covered this, but just to drive the point home, during client reviews, often people are asking about the performance that we've seen in large cap tech stocks and how they're leading the market higher. And over the last 10 to 15 years, that's kind of been an area of focus. And the question is, well, why should I be diversified when we've seen such a strong leadership, particularly in large cap growth over the last 10 plus years? Oh, it looks like you have a slide for this.
I do have a slide for this. Well, we'll go back to the one that we covered a minute ago. Just we'll spend a little bit more time on this diversification chart. So as you said, we often get asked, why not just own the S&P 500? It has done very, very well for the last, pretty much since the financial crisis of 2008. U.S. technology stocks have most of the time have been the place to be. And I'm not saying that those, Microsoft, Apple, Google, Amazon, those are great companies. They're iconic companies, and they will likely continue to do well as businesses for quite some time. The example that I'll give, in addition to just sort of showing on screen that, things can sort of change very significantly year over year. Commodities, as the example we cited a minute ago, can go from being the worst performing asset class to the best performing asset class. But when we look back to, past periods, and I'm not saying we're in the dot-com bubble, but using that as an example, there were wonderful, wonderful companies like Microsoft that existed in that period that were not good investments. And what I mean by that is, if you invested in Microsoft at the height of the tech bubble in the year 2000, you invested in a phenomenal company that was going to change all of our lives in ways that we couldn't foresee at the time, or at least change our business lives and the way we compute. But the stock had gotten so expensive, Andy, that it took almost 15 years for you to recoup your investment. Your investment would have been underwater for 15 years. So we try to focus on, not only what we own, the quality of the companies we own, but the value, the price that we're paying for them as well. And, we have exposure to those large technology companies too in our portfolios. We think having a healthy dose of that is important, but we also want to be diversified, particularly in areas where we see a good relative value opportunity.
Derek, you just said the word value 2 or 3 times here in the last 30 seconds. It is noteworthy for our viewing audience that over the last 100 years, there have been 2 decades in which growth outperformed value, and they were the 2010s and the 1990s. In the other 8 decades, value stocks outperformed growth. So that should be a good, not so subtle reminder that diversification and buying into underloved assets can be a smart thing to do. The other thing that's come up a couple times, especially earlier this year, is, are we expecting to go into a recession in 2023, and how would that potential impact our portfolio positioning for our clients?
Yes, great question. So, the last 3 recessions that we've been through in the United States all occurred in this century, in the last 2 decades, and they were all on the more extreme side of the ones that we've witnessed and experienced as a nation over the last 150 years. So I think our memories as individuals and investors, we remember COVID, we remember 15% unemployment. We remember the financial crisis. We remember people losing their homes. We remember, you and I remember just what that did to portfolios and stock markets. And in the early 2000s, after the dot-com bubble on September 11th, we went through a pretty significant and long recession during that time as well. And those 3 were some of the more significant recessions that we've experienced as a country. They just happened to be the last 3 that we've experienced. However, a recession is just defined as 2 consecutive periods, at least 2 consecutive periods of declining economic growth. So that can be a relatively modest and flat period, a period of consolidation. And we've witnessed those in the 90s and the 80s and the 70s. So we don't anticipate a significant recession, partially because we don't see nearly as much leverage in the households. We don't see nearly as much overspending or exuberance. We also see, relatively stable financial conditions. We see an accommodative Federal Reserve, a Federal Reserve that's able to lower interest rates if needed. And lastly, I would just say that we see a really, really robust labor market, as I said. So it's possible that we could see a slowdown in the economy. We're probably living through that now, quite frankly, but we don't expect any sort of economic catastrophe or significant recession.
Thank you, Derek.
Yep.
Well, I'd just like to tie up with a couple parting comments. One is that earlier this year, we announced two new divisions. One is Evergreen Institutional, which is focused on investment management and board governance needs of nonprofit and endowments. We also introduced Evergreen Exits, which is focused on helping business owners plan for their eventual exit from their businesses. If you are a board member of a nonprofit or endowment and your organization is putting out a request for proposal, please consider our firm. We'd welcome a chance to respond to your RFP or request for proposal. Secondly, you can learn a little bit more about Evergreen Institutional by visiting our primary webpage, egwealth.com. If you're interested in learning more about our business exit planning division, please visit egexits.com. We decided to launch that as a separate brand. Note that we have an experienced team of exit planning consultants. And I thought it might be good just to go through the members of our team and go through either the current or new designations that we've added, just so you can have a sense of the strength and the robust nature of what we're dealing with here. Several members of the investment committee are chartered financial analysts, including both Derek and Martin. Within the lead advisor side of things, Jim Dinsmore has been a longtime certified financial planner, CFP, also a chartered life underwriter, CLU, and he recently obtained his CHFC, and his motivation for that was an added focus on blended and modern families. Ed is he's two designations, both of which are focused on business exit planning. One is the CBEC, Certified Business Exit Consulting designation. He also recently obtained his CMAA. It's a Certified Mergers and Acquisitions Advisor. So that's been a strong area of Ed's focus over the course of the last 15 years or so of his career, is working with business owners as they prepare for their eventual exit. Likewise, I have a CEPA designation, Certified Exit Planning, which is focused on exit planning for business owners. And I recently obtained a CPWA, which is a Certified Private Wealth Advisor, which focuses on the needs of high net worth individuals, focusing on the life cycle of wealth from accumulation to preservation and eventually distribution. So that's not even mentioning Michael and other members of the team. I just wanted to mention that that we really value ongoing education at Evergreen. So with that said, there's a couple ways that you can keep tabs in addition to these quarterly webinars and your ongoing reviews. One is that we are consistently publishing white papers, both on things like the Roth conversions that we had discussed and market trends. Those are available on the webpage, but they're also available on social media. So we usually post those on both LinkedIn and Facebook. I'd ask that you follow us on both Facebook and LinkedIn under our individual names and also under Evergreen Wealth Solutions. We also have a very robust podcast offering, and you can find that on any of your distribution, Apple, Android, whatever. But it's under the title Plan, Grow, Prosper. So I'd ask that you chime into that. There's a lot of good information on a variety of topics. So with that said, I'm really glad that you're able to join us during this time. Derek, thank you so much for your time and energy and the involvement of the entire investment committee in preparing all this information and all the work that's done on behalf of our clients. We look forward to seeing you next quarter and hope that you have a great rest of your summer. Thank you for joining us.
Thank you.